Imagine you had the portfolio of your dreams and then one day you lost it all. How would you get that back? Hi everybody, welcome to Journey of a Property Investor. Today I'm joined with Mike and myself, Dave Guest. Mike, how are you, mate?
I'm very well, Dave. How are you?
Yeah, I'm good.
How was Rome?
Rome was really good, actually. It was really good. Obviously, we went there to watch the rugby. Sadly, England lost. But it was a good game, good experience. It's nice to have a look at some stuff there as well. We went to have a look at the Colosseum. Have you ever seen that?
I've not been to Rome, no, not yet.
How long do you think it took them? A genuine question. How long do you think it took them to build that Colosseum?
I've no idea.
8 years.
Really?
Yeah. So
Wow.
it was like 2000. I got on ChatGPT when I was looking at it outside, and it was, I forgot the bloke's name who started the build, but his son carried on with it, Titus. 8 years. I looked, and I mean, there's so much detail and everything about that building. Even now, it's 2,000 years old.
That's pretty good.
And I just thought, it leaves you looking, because there's loads of beautiful stuff around there. There's like that. There's the Vatican, all that stuff. But I was just thinking, 8 years to build such a spectacle that's lasted like 2,000 years. What's left behind from now? What do we look at in 2,000 years? I mean, we can't even build like a HS2, the train track from Manchester down to London with all the technology we got.
Do you know, I was thinking the exact same thing. I was thinking it was supposed to be finished in 2026, right? And
exactly.
And it's how many billions behind budget and things?
Billions, the technology we got, everything.
Yeah,
it's like, what do we leave behind? But anyway.
We digress.
Fantastic trip. We better get on with the show, hadn't we?
Yeah, let's go.
Let's start off with the Agony Uncle's question. So, producer Aaron, what's today's question for us?
So, today's question comes from Joanne. It is on Spotify. Thank you for your comment. Is there a minimum return of investment you would both seek out to justify whether you declare an investment a good deal?
Ooh, that's a good one, isn't it?
Good question, Joanne.
I think there's a few different sides to that. I mean, first of all, it's got to be a number you're happy with. And I think the first thing to think about there is it your money that's sat in the bank, or is it money that you've loaned? Because if it's your money sat in the bank, that's one figure, isn't it? You've got to go, okay, am I earning money on it elsewhere? How much is it earning in the bank? Is it 1%, 2%? Are you happy with that? Or is it in stocks and shares like the S&P 500 and you might be getting 10% on it, maybe, in the S&P 500 on average, it works out at. So I think you've got to look at where is it now, what's it returning, and are you happy with it? From that, then you can start to think, well, if I put it into property, then I want at least 15% or 20%, whatever that figure is. So that's the first place I'd start if the money was my own. If it was money I was borrowing, well, you've got to take that into account first, haven't you? So if it's investors' money or bank money that you are actually leveraging in the first place, whatever deal it goes into, the final ROI has got to cover all of that and still make some for yourself. What do you think, Mike? Where would you be with that?
That's
What's your answer?
Interesting. That
you should have just replied with that and says 11.7%. And then left it at that.
I wouldn't be happy with that.
No, you wouldn't, would you? But it would have a point in it. It'd have a decimal point with you. Yeah, go on.
For me, it's more about, and this is always the case with risk and with ROI, return on investment, or the returns an investor is happy with, is what level of risk do I need to take to get that return? And so you may well have heard of...
So you factor risk into
absolutely.
What the figure is as well.
Absolutely, yeah. And so does every investor, or they certainly should, is higher, typically you've heard low risk, low returns.
Yeah,
so you mentioned the S&P. You've got bonds, which typically yield less than equities. Equities are higher risk, but they give higher returns, right? So the more risk you take, you should be compensated for taking that risk. So which is why you would expect to get a higher return on a HMO project or a flip or a development project, because you're taking more risk, and so you want to be compensated more. And the banks understand this as well, and the commercial lenders, and they're not going to lend on projects that do not have higher returns. So typically on a new build development, you might be looking at 22 plus to 25% return as far as what you need to have to be able to get the bank to be comfortable to lend you the money to do that development. So just to bring that all back to a head, I would say the higher the risk, the higher the return. There are some rule of thumbs. Typically, single lets will yield you anywhere between 6 and 10%. An HMO might yield you anywhere between. I wouldn't look at an HMO if it was not 15% or more.
Yep. Because of the hassle, because of the risk, because of things like that.
Just
You've
the
got to
increased
factor
risk,
that
the
in.
increased
Yes.
work. You want to be compensated for that risk. And but ultimately, as an investor, and we've got lots of students that do this, is if you find the right opportunities and add enough value and you can refinance it out, we've got investors that are getting infinite return on investment because they're pulling all of their cash out of a deal. So they might have initial capital or investment that they put into a deal, but the way that they are structuring that, the strategy that they're using, they can then use their knowledge to then add enough value to refinance that out, pull out all of their initial investment capital.
But then to answer the question here, they would still be looking at what's the right amount to... What is the right figure to get return on investment for that cash once they've pulled it out? How do you get to the point of knowing what figure works for you? How do you look at something and go, that figure's right? Because there are lots of different ways. Like you say, you can do a deal, infinite return, blah, blah, blah. But how do you get to the point where you go, actually, that percentage is good?
Okay, good question. Everybody has their own appetite for risk. And so whenever giving financial advice, you always have to understand what somebody's risk appetite and their profile is. And so, it might be at different points in your life. If you're young and you've got time and you can take more risk, you might want to go for bigger returns and do more risky deals.
So I guess that's the first thing to factor in, isn't it? If you are after a high number, that's great.
What do you
need? But accept the fact, if you want to get a higher return, that you've got to take a higher level of risk. I think that's a good starting point, actually, Mike.
I would say, what do you need from property? And then which strategy or which method is going to be the best way to helping you get that return that you want? And it's going to be different for everyone. Some people might be happy with a 10% return. And then some people might want, if they have the right knowledge and they understand that you can get much higher returns, they're going to be shooting for those returns as well.
Agreed. So I think, just to summarise there, then I think it's start with your risk profile, see what that is, see how that aligns to what then your appetite is and what you can expect. But it is a very personal thing, isn't it? And I'd always look to see as well, what are you earning on at the moment? What is it you would like? And then, like Mike said there, factor in the risk to see how far you want to go. So, Joanne, hope that helped. Anybody else who's got any questions that would like answering in the Agony Uncle section, please put it in the comments below. We'll see if we can get those questions answered for you. So, on with the show. So, Mike, producer Aaron has given us a dilemma to answer this time.
I do like dilemmas, yeah.
I don't like this one because I don't like where it takes your mind. Imagine you've got the portfolio you like, or imagine our portfolios.
Yeah.
And then you've just lost everything. Right,
Again.
For the fourth time, you've just lost everything. Where would you start in building that back up? But he has been kind to us. We've got 100 grand given to us.
All right.
Interestingly, you haven't asked where that 100 grand has come from, have you?
Well,
I said, where did it come from? He says, maybe someone down the pub or someone like that. So I want to know where he drinks. Yeah. Oh, yeah, I've lost everything. Oh, cheers, 100 grand.
Yeah, why is a guy at the pub giving us 100 grand?
Yeah, I like the way you were straight to, and you've got 100 grand. Sound. You were straight in shopping mode then.
Are there any ties or any conditions attached to this 100 grand? I don't know.
So you've had this epic level of unfortunateness, but actually it's been balanced out by you've just had 100 grand. Where would you start?
Yeah, first thing I would say is there are a lot of investors that start with far less than 100 grand. So you're actually in a very strong position of available options.
Oh,
and what you
on
could
my
do.
life, yeah. How long have you been in property?
Over 10 years. 11, 12, 13 years, something like that.
So it's probably about 25, 30 years of experience in this answer. Seen different markets as well over the time.
Ups and downs.
So we better not disappoint. Yeah.
Ebbs and flows.
Yeah. So, okay, yeah. It's not a bad place to start, is it, 100 grand? But think about it, though. You're not just going to be able to go, bang, out there, buy a house straight away, and full cash. You're going to be doing some lending on there.
Well, you could. There are some places where you can buy houses for much less, and you could do that. You could go and buy something for cash. But let's just paint the scenario a little bit. So, assuming that you've had the portfolio of your dreams, you've got some knowledge, you kind of have done something in the past, so you can maybe use and leverage that. And I think if you're new to property, that would be a good lesson to learn, is that somebody that loses everything that starts again and is successful, you know, they've had some knowledge, experience before. So maybe if you're new, that's a good place to start, is knowledge and experience. What can you do to gain that knowledge and experience? So assuming that I had, you know, portfolio of my dreams, you know, which dream is it? Dream 1, 2, or 3? You know, my first dream, we're probably looking at 5-10 million portfolio, maybe then 100 million, and then I don't know. I don't want to say billion because that's
right. I'll tell you
silly.
what. If you've just lost £1 billion portfolio and someone's give you 100 grand, you ain't going to be happy at the 100 grand. You're still going to be crying.
I'd be like, I thought I'd made better friends than this. Yeah. So, okay, let's just rule out the first thing, and that's red or black. You know, so
let's rule out the fact that you're taking this in a suitcase to Las Vegas.
Well, what's the buy-in at a high stakes at the Bellagio these days?
Yeah, probably about that.
About 100 grand.
Wow.
£100,000 or dollars.
Could you imagine that?
So what I would say is, if you've lost everything, you're starting in a pretty low place, right?
Yeah.
I'm talking psychologically, mentally.
Yeah.
You know.
And let's add some sensibleness. Let's just say that there's been a market. You've got a reasonably sized portfolio now that's supporting you not having to go out to choose not to have to go to a job every day. So it's a reasonable sized portfolio, nice, good and honest, but there's just been some market conditions that have just happened, and then that meant that you defaulted everything, it's all gone.
You have been repoed.
I know, but now I'm just thinking, are you mortgageable? Are you still mortgageable, producer Aaron?
No. Let's assume...
No, he's got the rules.
Oh, sorry.
Are you still mortgageable in this scenario?
Yeah, I think we're in a scenario where like you haven't done any dodgy dealings.
Divorce, or so you've had to sell it all, or something like that.
Imagine it's a magical scenario and some
All right,
evil person has clicked his
Like
fingers.
a nasty wizard.
I've got an idea then.
Okay.
Let's say that I am mortgageable and you are not. And then we can look at it from both angles.
That's
or we can do it
interesting.
vice versa.
No, you've said it now. Let's go with that.
So Dave's the one with the bad
then.
credit rating.
Mr. 999 credit rating. Away you go. What would you do? Well, I'll probably just accidentally buy an house. Yeah.
Yeah. I'd probably go back to some of my friends that still liked me and where I still had some dignity and talk to them about some projects I was looking at.
So go for it then. You're mortgageable now. What are you going to do with your 100 grand?
Okay, so we're ruling the casino out, right?
Yes.
Yeah. Okay.
Well, I'm not at this
So
point.
you've got to think about it psychologically from where, in what kind of position are you starting? So you're probably going to be pretty down and probably maybe depressed about it, but you're going to have, you know, that grit, that drive, that ambition, which is what you're going to need to succeed.
Yeah.
100 grand or not, like I said, a lot of investors start with less than 100 grand. So if you've got that grit, determination, belief, the mindset and everything to, you know, take the steps and the actions to make things work and start building momentum.
That's it. The depression's gone. You're no longer pouring whiskey on your cornflakes. Away you go.
Yeah, there's loads of different things. Speaking of whiskey, don't know if you can see the inside of this new jacket here, but we've got some whiskey and some cameras and clock. I don't know why that's...
Well, there we go.
Anyway, what were we talking about?
Where are you going to start?
Okay, I'd start at the end and work backwards. So what am I looking to build up again? Obviously, I'm wanting to replace what I've recently lost. Okay, let's ignore the circumstances of why that is, assuming that I'm mortgageable. So 100 grand is actually, you can do a lot with that. So we just mentioned a moment ago, 100 grand is enough to go and buy a house. You can go and buy a house, renovate it, sell it. You know, you're a little bit at the mercy of the market conditions. So depending on where the market conditions are would depend on the type of strategy and approach that you would take. So, you know, thinking about buying a property, adding value and flipping it, which you could do with 100,000, you're kind of going to rely on the market conditions of what the sale value of what that's going to be at the end of the work. You're going to tie up a lot of capital. It's going to take a lot of time, but you could make some money, but you're kind of at the mercy of the market, right? So if the market is going down, it's not a great time for flips because you want the market to be going up in order for you to maximize the end value of that property. You don't want to spend all this money on doing a flip and a renovation for the market to have dropped the 20% that you're looking to actually make as margin, and then you're basically going to get your money back, if not lose money. Flips would depend on the market conditions. There are lots of other ways that you could go around using that money. So, for example, if you were going to use financing, assuming that I am mortgageable. So there are lots of different financing mechanisms. If you're finding the right types of deals and opportunities, you can put down as little as 10% on a property to buy it, control it, renovate it, add value, extend it, convert it into a HMO, run it as SA, split it into flats, whatever. I said start with the end. Am I looking for cash flow? Am I looking for capital value? Am I wanting to return this 100 grand as quick as possible?
I would say you are looking for cash flow, aren't you, really? Mm-hmm. And you've got that 100 grand. What's the first thing you're going to go, right, this is where I start? And I think the reality is, it is where you're going to start, because 100 grand is not going to get you to £20,000 a month's worth of income, for example. Unless you find a JV partner along the way,
Assuming you're not finding a JV partner, we're not leveraging or borrowing any other money from other investors, maybe banks potentially, but there's a few things that you could do. If you had that sort of money, you could work with some deal sources, and you could get some rent to rents. If you're talking about cash flowing strategies, you could get rent to rents, you could do short term lets, serviced accommodation, and that's great for cash flow. Mm-hmm. You can try and find some retiring landlords, maybe give them a little bit of money up front, work on some kind of vendor finance. You could look at options and various things and work with sources to bring in the deals and opportunities, pay them their sourcing fee, look for low and no money down deals, and do it that way. But I just wanted to focus a little bit on some of the bigger deals, because I don't want to take away from your thunder from your unmortgageable position. But what I would say is that, there are bridging and mortgage products that will enable you and allow you to do same-day remortgages now. You can put down 10% deposits and borrow the rest of the purchase price, and then renovate and add the value, and then refinance out onto longer-term products. There are lenders out there that will do that as well. So I would want to put that capital to the best use using sort of, let's say, the higher end strategies, albeit managing the risk, managing the builds, the renovations, developments, whatever it might be.
Would you go for something? But like I'm thinking about your Newcastle property. Would you go for something like that? In that 12 months, would you just focus on something, like a big one thing, and go, right? Because I'm thinking in this scenario, if that's your only income, you've got to work on getting some income in, haven't you, really? Mm-hmm. In my mind, I'm going, right, I've got to get £2,000 worth of income per month.
Yeah.
So £2,000 a month coming in, clear. Mm-hmm. That's the first thing I've got to do.
So in that situation, you'd want to look at landlords that have problems, tired landlords. Given the market conditions, it's a great time to find landlords that are exiting the market. In fact, I read something this morning that was talking about how there's actually a massive rise in people offloading their properties, landlords offloading their properties before the 1st of May, putting them up for sale, increasing Section 21 notices for tenants, getting them all out. So all of these things, this is a lot of uncertainty and worry for a lot of investors, but for the educated investor that operates professionally, it's a huge opportunity to be able to help these landlords exit the market in tax efficient ways, in organised, structured ways, whereby they can still maybe profit and get some of the money. They don't have to. It's not a fire sale where they have to drop prices. And if there's obviously supply and demand, if there's lots of landlords selling their properties, and also tenants moving out of those properties, if they're giving them the Section 21s before the 1st of May and the changes come in, then that creates sort of a boiling pot of opportunity in some ways, but also struggle for others. Of course, renters are going to find it a lot harder to find places to rent because they're now being asked to leave their properties. It's going to be harder for them to get into new properties because the background checks and the guarantors and all these, the bar for qualifying for property is going to be a lot higher. Agents and landlords are going to be a lot stricter about who they're allowing into these properties. There's going to be a lot more background checks and a lot more, they may even find a lot more credit checks and things that come in. It may even start looking like mortgage underwriting for tenants. That level of scrutiny, and we want bank statements, we want pay slips.
I'd never thought about that, but I think you've got a good point there, because it is a longer term relationship that you're taking accountability for, isn't it?
Absolutely, yeah, because the Section 21's gone, so you've only got your statutory eviction criteria that they have to sort of, and some of those are going to be mandatory and some of them are discretionary, but they're all going to have to go through the court, and it's backed up, and the system is just going to implode on itself. But so what would I do with 100 grand?
Well, where would you start? Because I was thinking in my mind, right, okay, I'm obviously not going to be earning, and I've mentioned that I'll be thinking to myself, I want £2,000 a month, which is 24 grand a year. The question that we had earlier in the Agony Uncle section was, what return on investment percentage would you put on some savings? I'll be thinking, right, if I want £2,000 a month to get starting with, that's what, 24% on return on investment? So I know that everything that I look at has got to be a minimum of 24% return on investment. Otherwise, I'm not going to get that £2,000 a month.
Yeah.
So I think that would be my evaluation criteria from what I looked at. And obviously, if I looked at something that was better, that would be where I would start. And I think being unmortgageable, the first place I would start is, I think, rent-to-renting.
Yeah.
So if I could get some rent-to-rents, I'd look at two things. I'd look at serviced accommodation, because there can be a good uplift there. So I'd look at getting some of that in place and starting that off myself, and then eventually, where you said start with the end in mind, I'd want to hand that over to some form of management company. But what I would also do for some more consistent income, because that, it's very good service accommodation, but it can be like that, can't it? What I would do for the other side to balance that out is I would look to work with an assisted living provider and take something, rent it to them, put it on a long lease, sit in the middle and take some money that way. So I know that that's very consistent every month, whereas the serviced accommodation would just give me higher income at certain points of the month and lower at others.
Yeah, that's interesting. I actually had a call with a young couple yesterday, and property investors, they got a few properties, and one of which is a serviced accommodation that they've recently renovated, sort of big refurbishment, rewire everything, spent a lot of money on it, and looks fantastic. But is it in the right place? Is it seasonal? They're struggling at the moment to rent it out and cover the costs. I think it's perhaps more a seasonal touristy location as opposed to in an area where it's going to be full all the time. And if they've done it to a high standard and it's a great property, then it may well be that you can be empty 6 months a year, but still make a killing in the 6 months that you're full, right? So, not to worry about that. But definitely serviced accommodation is a good shout as far as a cash flow. It's high cash flowing. You can leverage other people's properties in order to be able to do it, albeit you have to make sure you're doing that in the right way. My struggle with serviced accommodation is the fact that it is a service business and it's VATable. So if you have a successful service accommodation business, as soon as you hit the VAT threshold, you're losing 20% of your revenue.
You are. I mean, but that's a good problem to have,
it's
though.
A good problem to have,
80.
but you've got to factor in the other high overhead costs. You've got your travel managers, your OTAs, you've got your cleaning, your linen, laundry,
in this scenario,
utilities, your mortgages. You've still got all these costs.
In this scenario, I'd probably be doing that myself for the first few.
Yeah, exactly.
And factoring it in. But I'd only want a couple of those and a couple of the rent-to-rents for the assisted living. All I'd be focused on was that £2,000.
Yeah.
What I'd be using the additional money for, I'd be using the additional money to look for flips. So I'd be going around looking for building opportunities to take parcels of land, put an option agreement on them.
You do love a flip, don't you, Dave?
I do, because it gives you a chunk of money.
Yeah. But does cash going out all the time? Cash going out, market conditions?
Not if you do. So what I would do is, everybody wants a good piece of land, small, good piece of land. If you can tie that up on an option.
When do you get paid for it?
Well, as soon as you sell the option. I wouldn't want to do any of the development.
So you're talking
nothing.
About planning uplift?
Yeah. So all I would be doing, I probably wouldn't even do the planning uplift. If you wanted to turn it round quick, you're going to take less out of it. But if the opportunity's there, you've tied it up with the vendor, you could pass that on.
Right.
You could even say, well, I'll tell you what then, you put the money in to do the planning.
Let's come back to that in a minute. Just to finish off and conclude on the serviced accommodation, it's not that it's a good way to generate the cash flow. And you could get to that 2K. I was doing a rent to SA. I had a property that I was running as a serviced apartment, 1-bedroom property, not in a great condition. I was making $1,500 a month net after all operating costs on that. So you can quickly get to that.
Look at that straight off.
Well,
you get two of them, and I know in this scenario we was probably. Well, you was on private jets and Bugattis, weren't you? But straight away there.
You're playing around with AI again, Dave.
If you can't live on $3,000, you've got a bit of a problem, ain't you, really?
Well, it
your
depends.
problem's a spending problem.
Okay, let's go back to the original scenario. You've lost everything. Well, why have you lost everything? Maybe you are in debt. Maybe you still got things that you need to clear off. Who knows what the situation is? We're assuming...
Producer Aaron says a wizard came along and just did it to you.
A wizard came along, clicked his fingers, everything disappeared.
life is unfair.
Yeah, that is like playing snakes and ladders. You can see number 100 and you hit 98 and you've gone down that snake right to the bottom.
Again,
yeah.
And Snakes and Ladders is on our artwork, so nice.
Ah, yes, it is. Yes.
it's great artwork. Shout out to the artwork. I do.
It is really good in it. I do
yeah.
like that. Yeah.
Coming back to my point,
Yeah.
SA it's a great cash flow model, but it's also a service business.
Yeah, agreed.
You're at the mercy of the guests and the reviews, and every visit has to be spotless, 5-star experience. The cleans have to be perfect. And I'm not saying it's not a good strategy. It absolutely is, but you do have to remember it is a service business, and you have to treat it like a business, run it like a business, and everything has to be systemized in order to maximize.
I would
the
say
opportunities.
everything you do in property should be that. But would you just caveat that with it's even more?
Okay, yeah. You need to systemize as much as you can, but given the higher turnover of guests,
Yes,
as opposed to tenants,
yep.
And you've got lots of other moving parts like the cleaning and the laundry and the channel managers and different multiple platforms and channels. Are you taking direct bookings? Are you booking on booking.com? Are you booking on Airbnb? All of these systems have to be in place, and it's far more.
I'm going to do the sheets on mine.
Yeah.
I've used some of the 100 grand to buy 2 commercial.
I've done it.
Tumble dryers and 2 commercial.
I've done it. Yeah, I've gone in, not bought the double tumble dryers, but I've gone in and I've done all the cleans and the changeovers and things like that. And you're
that's
saving
quite
a bit of
humbling.
money, but it's not the best use of time. So you need to get to the point where you can scale and leverage and get
Well,
people
I've got
in.
to try and make myself mortgageable because the wizard made me not mortgageable.
What did you do to the wizard?
I don't know.
Did you upset him?
I must have upset him more.
Yeah.
Yeah, you can have a bad credit score. What?
So, okay, yeah, that was just what I wanted to say on serviced accommodation.
You know what? It's important experience to share, that is.
Yeah.
And I think as well, I'm the same as you, and I wouldn't want to do it now because I'm quite comfortable.
Mm-hmm.
But actually, if you put me in that situation that the wizard has, where I'm uncomfortable, I'll be thinking, right, this is a good way just to do something now, isn't it?
They say that necessity is the mother of all creation, and when you're put with your back up against the wall, you're going to try things, you're going to do things, you're going to work harder than ever before to make things work. And you could easily get to the point of $2,000 a month with $100,000 of capital. Like there's a guy in our mastermind, shout out to Andy. He works with deal sourcers. He's taken over SAs. He's taken over properties, refurbished them, running them as SAs, and he's killing it. And he's done multiple deals, and we're not even halfway through our mastermind year, right? Andy Potter.
Oh, I know Andy.
Yeah.
Oh, well done.
Shout out to Andy.
Yes. Hi, Andy.
And actually, he did comment in our mastermind chat this morning about the podcast. He said, "Oh, great job, well done, guys." So thanks for that.
Like and subscribe.
Yeah, like and subscribe. Yeah, cheers. Well, checks in the post.
Yeah.
So $100,000. I don't know what you're paying for deal sources. 6 months cash flow for a deal.
Yeah.
Are you paying a fixed fee? Depending on the project, I don't know, you might pay 5, 6, 10 grand. If you could get 10 deals at 10 grand a pop, and we're talking creative acquisitions. We're not talking necessarily about mortgages here, and albeit you can use the mortgages to flip these properties, to renovate them, to then refinance them. You could get 10 deals. You could go to deal sources and just tell them you're looking for lease options, and you pay up to 10 grand for each one. You could get 10 lease option deals in a year.
So you would look at sources then, would you?
I would consider it. And in fact, actually, I was talking to somebody, we had our strategy implementation live. Well, I spoke to a lot of people, but our 3-day event in the spring, which was amazing. There was, 300 investors in total there, in person, online, etc. I was talking to a lot of people, and there was quite a few deal sources, and they're like, we're finding deals and working with investors. I had a call yesterday, a follow-up call with somebody, and they said that they've had 10 follow-up calls, like virtual coffees or meeting up with people, calling him up, wanting to JV, wanting to work with him, and he's a deal sourcer, and he's looking for deals, and he's lived in a few different cities around the UK, and he's finding opportunities in these deals. And he says, I've got some in Birmingham, I've got some in Newcastle, I've got some in Cardiff, and looking around. So,
would you set yourself up as a deal sourcer?
One of the highest value tasks as an investor is finding good deals. So whether you're a deal sourcer or not, you have to get good at finding deals.
Yep.
I mean, fair enough if you want to take a different approach and say you're just going to work with deal sources, but you have to find good deal sources that are finding good deals, because a lot of it's junk, and we know that. They're not good deals, they don't stack, they're they're fudging the numbers to make them stack so they can sell them on. But obviously, a savvy investor is going to see straight through that. And even when I was a mortgage broker, I would have people that had brought deals to me to finance that they'd bought or were in the process of buying from deal sources, and they just didn't stack, and you couldn't get a mortgage on them for what the figures were that the deal sourcer was presenting them at. So understanding how to stack a deal,
common, isn't it?
Yeah. So I would work with deal sources. Of course, I would look for my own deals as well. Obviously, if you've got all the time in the world and 100 grand, you've got some capital. You could maybe set up a website. You could start doing some lead generation. You could do some Facebook campaigns, even or Instagram ads or whatever. And even if you just said, I'm looking for properties in this area, and just push that out, you could spend, I don't know, a grand or two on marketing and try and generate some leads that way. There are lots of companies that, the cash offer will buy a house, will buy a house within 7 days and quickly. I would talk to some of them.
Yes. I mean, that's a great thing to do as well, isn't it? Most people just think, the only thing I can do is sell through them. But you're saying you would get in touch with them and say, what are you doing with some of the other leads that you don't use?
Yeah.
Brilliant idea.
When your feet are to the fire and, let's say you've got kids, you've got family to feed, and you've lost everything, you need to go out there and make it work. You need to become a hunter and go out there and find the deals. Absolutely. Or find the people that have got access to the deals. You've got a bit of capital that you can use to help kind of put the wheels in motion and put some oil in the engine, fuel in the tank, and you can...
Okay. I'd portion half of the money to do some form of rent-to-rent. So I think I would do that, like I mentioned before, I'd do some SA, and I'd use the others for the assisted living, what I've done, for that steady income that you've got locked in. I would then start to look at how I can do some sort of flip, because I'd have 50 grand left. So I've got 2 grand coming in now. I'm keeping the wolf from the door. I've got some money coming in. I'm getting a good return on that money that's left in as well. And I mean, actually, if I'm saying 50 grand for rent-to-rents, that should be enough for them, shouldn't it? So now I've got 50 grand left, and that's enough to start doing some stuff with flips. Now, I'd like to flip properties, but the reality is you're not going to get a flip for 50 grand. Or you might put a deposit down. Or I might be able to buy my own place for 50 grand, but that's just a deposit, and then raise the money elsewhere.
Well, I was going to say, if you were mortgageable, you could do a flip for 50 grand.
Yeah, but the Wizards made me unmortgageable. So I know if I'm going to move forward from this point and I want to own my own HMOs or other buildings, I'm going to need a good cash-rich joint venture partner. And this is my thinking behind the land.
Yeah, but he's already given you 100 grand.
No, that's the Wizard.
The Wizard might be the cash-rich investor.
I'll go back to the Wizard. Can I have some more money? Well, so what I would do is, if I'm finding pieces of land, and you can do that sitting just on Google, just looking for houses where there's something next to it, go and speak to them and start to talk to them and say, look, that parcel of land, have you ever thought about doing this, that, the other? Most people won't know how to navigate it, how to do it, anything.
I do that when I'm driving around, Dave. I don't even look on Google Maps. When I'm driving around, if I'm sat in traffic and I look to the left and there's an empty field and there's some houses on one side, house on the other, and there's a bit of a gap, I'll star that on
person who got me
on my Google
into
Maps.
all the planning and development side of things, Carl, the architect, that's what he used to do. He used to knock on doors, and then he'd get like a single development next to it, or a couple in the garden or something like that. Yeah. But I'd tie them up on an option. I'd either put that under an architect's nose then and say, look, have you got any developers who would like to do this? You'll get the fees off it, obviously, for the planning. So there's something in it for them to motivate them to find other people.
That's a good tip, yeah.
And then you're in with the developers, aren't you then? Anybody who's a developer is usually, in my experience, sitting on a lump, like a lot of cash.
Yeah.
And when they get to find somebody who's good at finding these things, I want to keep them. So I think I would get a few of them, and then I'll get them to fund my HMOs and my other stuff that I want to do to build out.
Yeah, so as opposed to being a deal sourcer, deal, everything's a deal if you're selling it on, right? So, but instead of finding properties to source and sell on, you'd find the land to source and sell on to do that a bit quicker, maybe. Yeah,
and I've got no problem with finding a flip to sell on, but that can be I know people now, obviously. If the Wizard hasn't taken them away from me, if I found flips, then I could put those with people so that we get a split on those as well. So that'd be like the strategy on what I would do. But where I'd spend most of my time is heavily networking, always around estate agents.
Yep.
I know landlord letters as well. I'd be putting those out to get the rent to rents because I think they're a great place to start.
Yeah.
So I think that's how I'd work it out in that way. Isn't it funny? But by giving, by giving a scenario like that, hypothetical, how it changes your thinking on where you start to look.
Absolutely. I think I would start to focus. Well, I think just thinking about it to conclude, it's I would focus on generating leads and filling a pipeline of potential opportunities, basically working with motivated sellers, get as many motivated sellers in the pipeline, whether it's my own websites, whether it's leveraging social media, posting about, sharing everything that you do, networking with investors, and then using some of that capital for the business side of things and doing that lead generation, but also working with deal sources, finding my own deals and opportunities. You go into an estate agent and say, I've got 100 grand cash, I'm looking for 2 properties in the next 6 months, what have you got?
That's a really good point, yeah.
You know,
that's a really good point. The fact that you could just, show them proof of funds
who
as
are
well.
they going to call first when they've got a great deal?
Ghostbusters.
And you give them your... You go in, you show them your proof of funds, they're going to call you first, and you give them your criteria and say, I'm looking for, you said a minimum 24%, right? To get that 24k a year that you need. This is my criteria. I'm only looking for deals that can do this, whether it's value add, whether it's conversion, commercial, residential, HMO, SA, whatever it is, whatever the cash flow strategy is. Talking to agents, great resource to leverage as well.
Absolutely. Brilliant. Mike, got to leave it there. Thanks for your time. Enjoyed the chat.
Yeah, same.
So there you have it, folks. If ever you're visited by a wizard that's sent by producer Aaron,
it's more a thief than a wizard, really.
Yes,
It's took everything that was ever important to you away from you and left you with 100k.
If you are left in that situation, then hopefully some of the things we've spoke about through today would inspire you to get back on the ladder and get that portfolio up and running. But joking aside, no matter where you start, it is really about mindset. And I do believe that if you're put in a situation or put yourself in a situation, then actually it is interesting how you solve those problems if you want and need them bad enough. So don't forget to follow us on Spotify and Apple, subscribe on YouTube and like the video. Don't forget to leave your questions in the comments below. Remember, it's not just about the destination, it's all about the journey. Thank you for watching.